Welcome back, everyone, to the Exchange Live. My name is Paul Hill, and I'm delighted again to be able to speak to multi-asset manager Duncan MacInnes of Ruffer. So welcome, Duncan.
Hi, Paul. Thanks for having me back.
Yeah, well, I'm absolutely delighted to have you here, particularly given all this sort of the uncertainty across the world at the moment. Plus, we've got, I don't know if anybody lost me there, plus we've got the overhang of the UK election and the US presidential, sorry, the UK budget and the US election. But before we sort of run through your outlook for the markets next year, I don't suppose you could just quickly remind the audience what kind of investor you are, how you sort of structure the portfolio on an asset allocation basis.
Yeah, happy to. I think I lost the first half of that question, so I don't know if.
Yeah, no, sorry, so did I. We went a bit dull.
Fingers crossed, it'll be okay. So Ruffer, as you know, Paul, and hopefully many of the listeners do too, we're a global multi-asset, go anywhere, absolute return investor. Today we manage about 20 billion sterling for a range of UK and global institutions and individuals. And Ruffer Investment Company, which is one of the two funds that I manage, is a London-listed investment trust, and that's about £1 billion market cap.
Oh, okay. And how do you sort of structure sort of from an asset allocation? What's the sort of the investment objective of the fund?
So the great luxury that we have is that our clients have afforded us being totally unbenchmarked. So we start with a blank sheet of paper and we can go anywhere in the world and invest in almost anything. And what we're trying to do is build a portfolio of individually attractive assets that when you put those individually attractive assets together into a portfolio, hopefully they have offsetting characteristics, and it results in having a balance of protection assets and growth assets. And that means that the overall portfolio, hopefully, can deliver consistent positive returns. All-weather returns is one way that we've described that, without necessarily relying on getting the market direction right or knowing what the economy is going to do, because as we all know, knowing what the economy is going to do or what the market is going to do is far from easy. And over the 30 years that we've been going, we've done a pretty good job of that. So we've delivered those consistent positive returns. The average annualized return over the 30 years is 8 after fees, which is about in line with the UK market and the European market, slightly behind the S&P, which of course we all know has been amazing over the last few decades. But it's fair to say that we've made the most money, especially relative in bad markets. That tends to be when we thrive, which is why we've got this bear market operator reputation. But we've made money through the 4 big crises since the firm began. So we were positive in .com, we were up 20 in the financial crisis, positive through the COVID crash, and then positive in 2022 when stocks and bonds both fell. And basically that's why we're very useful, we think, in people's portfolios, because we genuinely diversify your portfolio. And the lesson of 2022, even though that feels like quite a long time ago, was that portfolios are when you need them to be, far less diversified than you think.
Yeah. There's that sort of like
in a crisis, all correlations go to 1. You know, that's the old saying.
Yeah. So I guess you're not sort of like total Indiana Jones on the Mag 7 this year, but if you've delivered if you've delivered a good solid positive return over the sort of like
that's nice of you. Yeah. So we're up about 3 year to date, which is not bad. Certainly I would like it to be better. Over the last 12 months, we're up about 5 and a bit. That's okay. We are positioned bearishly at the moment, as we'll probably come on to talk about. So whilst being wrong, because we've been positioned very conservatively in what's been strong markets, keeping up with cash is okay. Given that through that whole period, we've carried a lot of protection. So had things gone the other way, had we had a recession, had we had a market sell-off, we would have done much better. It's an okay result, but on top of what was a pretty poor 2023, the worst year in our history in the 30 years, things must get better. We're very aware of that.
You sound like Tony Blair there. Okay. In terms of
only get better, I think we're maybe at that point as well.
Okay. What's been a real feature though this year across the sort of the asset classes is there's been huge dispersion. I mean, you've had basically, I think Nasdaq is up about 30%. You've got the S&P at 22%, of which that 80% of that growth in the S&P has been attributable to one stock, which is Nvidia. And then you come over to the Britain, you've had the FTSE, which is up 8%. Small cap AIM is down 3%, but also you've got gold, which has increased sort of like 35%. So putting that sort of huge dispersion of assets returns this year, how are you looking forward into structuring the asset allocation of the portfolio to get that sort of 8% all-weather sort of return for next year?
So I don't think the narrowness of markets is quite as extreme as it was last year. 2023 was almost absurd, and the gains came all from the Mag 7. This year, at least, you do have Europe up strongly. You have China up, although down a little bit from its recent high. So you do have a broader rising of all the boats this year. But you're right, the Mag 7 is now so dominant in its composition of the S&P that it has driven markets still. Looking forward from here, there's some pretty big known knowns to worry about, isn't there? There's the geopolitics in Taiwan, the Middle East, and the Ukraine continuing to rumble on. Recession risks and inflation risks may have abated a little, but I still think they're very valid to be concerned about. Fiscal sustainability in the UK and the US is something that's coming front and center, and perhaps that touches on why the gold price is doing so well. We have a UK budget next week, which is unlikely to be good for investors, and of course the US election and whether or not the result gets accepted and how long that rumbles on for is a problem. And then maybe the last one is are there any nasties lurking in the now vast universe of private equity and private credit and venture capital that we don't really know about? But the market's really looked through all of that over the last year or so. So our problem is that when we survey the landscape, we see a lot to worry about. Most of that stuff is quite well understood, but we just don't see the risks of any of those going wrong being reflected in markets. The compensation for taking risk, basically, I mean valuations or risk premiums in most major risk markets is very, very low today. So that doesn't necessarily mean that everything's definitely going to go wrong, but it just means that you are running risks and not necessarily being paid for them. And I rediscovered a quote a couple of weeks ago from Joel Greenblatt, and he said investing in high valuations is like running through a dynamite factory with a lit match. Just because you survive doesn't mean that you're not an idiot. And I think that there's something in that we're not necessarily saying everything's going to go wrong and when it's going to go wrong, but we're saying if it does go wrong, the downside from current levels of valuations, and we can go into the specifics of that if you want, it is potentially very, very large. So valuation tells you nothing about timing. We know that, but it does tell you how much it will matter when it matters, i.e. how much you have to worry about the downside. And that's not universal. There are cheap assets in the world, and we can talk about them too, but it is relevant to the world's biggest market, the US, which is 70% of global market cap, and the big asset classes like investment grade credit. So systemic asset classes are incredibly expensive.
Yeah. So I guess then the fundamentals of the economy appear as though they're going to continue chugging along in terms of there's no major sort of economic risks other than there's obviously some deleveraging that governments have to do. But essentially, the biggest risk to investors, if they're in these very sky-high valuation companies, is a reset on that rating, which might hit the sort of the Mag 7 and stocks like Nvidia, who have brought forward a lot of their sort of like a lot of their sales.
Yeah, exactly. So I think we may avoid recession. That risk of recession has diminished. But if we are avoiding a recession, then we are cutting interest rates into an economy that stays pretty strong and into an economy that we think is still very inflation prone. and therefore you have the risk of inflation resurging, and you have to question if valuations can continue to stay high if interest rates are high.
Yeah, good. And how, just on your sort of portfolio construction, how much do you sort of currently allocate to sort of like I don't know, bonds and fixed income versus equities versus gold and commodities and other assets, cash?
At a high level, we have about 30% in equities. We've got 15% in commodities, 2/3 of which is precious metals. We have a little bit in protection assets, the unconventional protections that we've talked about before, and the balance of the portfolio, which is just less than half, is in cash or cash proxies. And by cash, I really mean short-dated government bonds. So the portfolio duration, without getting too into the jargon, the sensitivity to interest rates is pretty low. It's 2, which has been helpful in the last couple of weeks, of course, because bond yields were low, having got very ahead of themselves and have started to retrace. So there's no doubt we have a very defensive portfolio at the moment, but it is less defensive than it was a year or so ago because we were very worried about the prospect of a recession in 2023. That hasn't happened, and now it comes back to this idea that the system is clearly fragile and valuations are high, but it's not entirely obvious what the catalyst would be right now. And governments are pretty determined to keep the show on the road through the election, at least via a desire to cut interest rates and, of course, massive deficits.
Yeah, it does seem as though the fiscal deficits are the problem, because I think consumer balance sheets actually, in contrast, are actually not bad, given the savings rates. Okay, if anybody wants to ask Duncan any questions, please pop them into the chat bot and I'll read them out. Just to let everybody know that Duncan really sort of deals at the asset allocation and top level large stocks. So unfortunately, we won't be able to speak on small caps today. So just to forewarn people. Now let's move to one asset class that
will not be very good.
Let's switch gears to an asset class that has done well, which you mentioned earlier on, is gold. What's your view there? Because it's really driven a lot of return. In fact, I mean, it's more than the more than Nasdaq. It's up 35%. It's now over $2,700 per ounce. Can you just talk through sort of the drivers of that? What's led to it?
And how you all day. So gold it has done very well this year and well last year. All-time highs at $2,700 an ounce. So that's more than £2,000 an ounce. Which an ounce of gold is about the size of a £2 coin. So it's quite expensive now.
Yeah.
It's been a big positive contributor to our portfolio. So we have about 9% in precious metals at the moment. We don't actually have any gold bullion. So we have 6% in gold mining equities. And then on top of that, we've got 2% in silver bullion and 1% in platinum. If you go back over the history of Ruffer, we've almost always had a gold allocation. This is one of the very few times where we haven't held any gold bullion. So gold is at all-time highs. It's done very well for investors. I think it's a bit of a canary in the coal mine, isn't it? The fact that gold is at all-time highs is telling you that something's not quite right in either the market or the global economic or global monetary systems. I do, for the first time, worry a little bit that gold is becoming quite expensive. So it's hard to value. Everyone knows that it's really difficult to nail down how to value gold. But if you compare it to inflation, if you compare it to oil, how many barrels of oil does an ounce of gold buy? You compare it to copper, it looks expensive. So those other assets look cheap relative to gold. There's been a strong correlation between gold and real yields over the last decade or so. That has completely broken down in the last year or so, where real yields have gone up, which would be bad for gold because of the opportunity cost of holding gold rising. That's not worked. Real yields would tell you gold should be well below $2,000. So my concern is to continue to be bullish gold bullion, and actually I am. you have to make a this time it's different argument. You have to, because the historic arguments don't really stack up anymore.
I've heard Paul Tudor Jones say that's dangerous, that 3-letter word.
Very dangerous. I mean, that's why I'm smiling, because this time is different. The 4 most dangerous words in the investment lexicon. I think it was John Templeton that said that. But things are different. They are demonstrably different. That there are clear fiscal sustainability concerns in all the developed market economies. Governments are not at all serious about tackling their debt problems. And then on top of that, ever since the Ukraine war, which is when these correlations started to break down, so February 2022, if you remember, there was the confiscation of Russian assets in the Western banking system. Those episodes were a warning to anyone who's a bad actor, or who might one day be deemed to be a bad actor by Western authorities, that you can't hold your cash deposits in Zurich, London, or New York. You have to have them closer to your home. And the best way to do that, because you don't want to hold them in your domestic currency, which is probably too volatile and fragile, is to hold physical gold. So what we've seen since 2022 is an enormous amount of buying from global emerging central banks, and also high net worth and ultra high net worth investors. And those ounces are moving from west to east across the world. And I suspect that they are going into a vault and they will never come back. So that is a properly fundamental change in the gold market. So, and the other thing I think that gives me comfort that you can continue to be bullish, even though things are getting a little bit frothy, is that Western investors haven't really come back. The last couple of months, we've started to see a lot of chatter about gold, but it's still not a big part of wealth manager or multi-asset type portfolios. There's a couple of months ago, but there was a Merrill Lynch survey that showed that I think it was 90% of portfolios had 1% or less in gold. So gold is under-owned, I would say. If you look at how many ounces are in the ETFs, they're still well below the 2021 high. So I think gold potentially has further to go. To come back to the Ruffer portfolio, we have decided to sidestep that now quite thorny issue of is gold expensive or not. And we own the gold mining equities, which I think are demonstrably not expensive. So the largest ones, Barrick, Newmont, these trade on about double-digit free cash flow yields, and the smaller companies trade on even cheaper valuations than that. So they don't need the gold price to go up from here to do well. Those stocks could go up 50% with gold being flat. And historically, they have had a higher beta to gold than gold bullion itself. But so far this year, they haven't really. So even though they're up 40%, they've underperformed. And so I think there's more juice to squeeze there, I think.
In terms of sort of like the gold miners, you mentioned, I think Newmont, actually, did they come out with sort of like a profit warning yesterday or something?
Last night they were down 14%. So I think that took them from about up 45 year to date to up 30 year to date. So they're still doing pretty well. It was a reminder, Mark Twain's famous quote was that a gold mine is a hole in the ground with a liar standing above it. The gold mining industry is notoriously flighty, badly run, prone to disaster. And this was a reminder that Newmont, which is probably the best company in the sector, certainly has the best assets, even they can have production problems. So if you are going to own gold mining stocks, you need to accept there's equity beta there. They are prone to disruption. So I think you have to own a whole bunch of them. And that's what we do. It's going to be a more volatile ride. But the all-in sustaining cost for gold mining production at the moment, I think is about $1,500, and gold is 2,700. So they are printing money. I saw a chart, which I have not fact-checked, but I think it's about right, that gold mining stocks currently have higher margins than the luxury goods producers. So clearly in time, that will be the seeds of its own destruction, and supply will come on to fix that. But in the meantime, they are hugely profitable if they can get the ounces out of the ground, which was Newmont's problem last night. Yeah.
Just coming back actually to the your overall portfolio, the one question I forgot to ask was just what's your sort of your targeted beta for if the market is a sort of like a 1, sort of like What sort of risk return are you trying to get?
I've been at Ruffer for 12 years now, and I don't think anyone's ever asked that. It's a perfectly reasonable
Sorry
question.
about that.
But I think the answer is that we don't have one, and you wouldn't want us to have one.
Yeah.
And the reason I say that is because the way that we think about it is that we're totally unbenchmarked, as I said earlier. That means that our investors or our clients delegate to us the decision of how much risk to take and when. There are times when you would want a very high beta.
Yeah, okay.
March 2009, to use your one example. And there are times when you would want a very low beta, 2022, 2007. And so the beta that we have to equity markets and which equity market will change significantly over time based on how attractive we think the opportunity set is. And over 30 years, we've been pretty good at that. We've earned that right. But in the last 2 years, we have done less well on that.
Yeah, okay. Yeah. So basically what you're looking for is the best risk-adjusted return rather than either the highest or the lowest asset, sort of like highest risk assets, etc., or lowest risk assets.
Yeah, absolutely. So to go back to that gold example, today we've got 9% in gold mining equities and silver. Yeah. We think that's better than having, say, 15% in gold bullion. But beta adjusted, they would be about the same. Yeah, but we think the risk reward of the shape of the silver and the gold miners is better. The downside is more protected because of the lower valuations, and the upside is potentially greater.
Yeah, okay. All right, well, let's switch gears to another sort of commodity and go to the energy sector. A bit more volatile, unfortunately, than gold. Let's look at your thoughts on oil going forward, but also sort of, I know you own BP as well. Yeah. So how do you see that sort of complex? Because we've got on the one hand the Middle East, but equally on the other side, we've got Russia, unfortunately, still pumping like crazy. We've got the US now the biggest producer. Plus, we've got quite a lot of spare capacity in OPEC, and they're suggesting they're going to reduce their sort of production outputs quotas
and drill, baby, drill. Trump maybe coming in
exactly
in a couple of months. So we have about 3% and a bit in energy equities, mostly BP, as you mentioned. That's 2.5%. And then we've got a little bit more in the oil exchange traded products, so physical ownership of oil futures. Actually, I think that oil is a relatively symmetrical risk reward from here. Well, my personal view, actually, I'm slightly more bullish than that. I think it's pretty remarkable that the geopolitical situation is so fragile in the Middle East, and oil is trading in the 70s. I think that to me says. There's very little geopolitical risk premium, especially because we know the economy has stayed quite strong. If the economy was weak, then maybe that would make sense. So I think actually it's quite asymmetric, but the majority of my colleagues are more symmetrical on oil from here. So why do we have this position? I think it's the portfolio role. So the way I describe it is that if you remember, Homer Simpson said that beer was the cause of and the solution to all of life's problems, and this you can buy T-shirts and mugs with that on it. So I think oil is the cause of and solution to a lot of your portfolio problems. So a lot of the things that could really derail the economy, Russia, Ukraine, the Middle East heating up, the return of inflation, these are all things that would be oil positive. Now, of course, a crashing recession would be oil negative, but a certain range of the risk scenarios to your portfolio are scenarios that are very bullish for oil. So I think oil is in a really nice position where it can work as both a protection asset and a growth asset. It can protect you from some of those bad scenarios, like we saw in 2022, where energy equities were very strong in a weak equity market. But also, oil is a GDP proxy, isn't it? You want GDP growth. You're going to use more oil. You're going to drive more cars. You're going to move more stuff around. You're going to fly more flights. So I really like the portfolio role of oil, even though it's very hard, as you say right now, to properly parse that supply demand dynamic. But in the background, you've got that ESG supply tightening ongoing. And to move to BP specifically. So you've just got a very cheap stock there. So
Yeah.
this has been true for quite some time, but it trades on about 60% of the valuation of ExxonMobil. Now, it's maybe not quite as good a company as ExxonMobil, but that's the wrong price. And roughly, you've got $100 billion enterprise value, so the market cap plus the debt, and it's maybe 110 billion, and it's producing, I think, about $15 billion of free cash flow that can pay down debt. It can invest in transitioning towards their new greener technologies, and of course, it pays a massive dividend yield, and it can buy back some stock. So I think you've got this. It has that nice hedge dynamic, but you're definitely carrying it positively whilst you wait for that to happen.
Yeah. In terms of sort of like it's different this time with the oil sort of like what seems to have occurred is another expression: high prices are a good cure for high prices. Because when it ballooned to 2022, everybody sort of turned on the production, America and obviously Russia as well. And we now seem to have a large surplus in supply. So demand is still increasing. I think it's I don't know, 100 million barrels per day, sort of like, a bit more. But the supply is still very high. So you've got that sort of like cushioning effect on it. So even if you get a geopolitical, that would be my only take on oil. That's
absolutely fair. The way we've talked about that internally. So totally agree with the cure for high prices is high prices. If any commodity has a very high price, then you tend to find a supply response eventually occurs. Now, of course, that supply response can take a while. Shale is a bit of a game changer in that shale can be turned on quite quickly, which makes oil different to, say, copper, where we see similar dynamics. So that is a problem. But the way we think about it is that there's a cap and a collar on the oil price. So it's unlikely it can stay north of 100 or 110 for very long without a significant supply response, like you say. But also, shale isn't really profitable below, of course, it varies from well to well, but let's say 60, 65, certainly doesn't incentivize new investment if oil's in the 65 range. BP is still profitable at that price. So I think it caps your upside, but it also caps your downside. That those very dynamic supply responses that you talk about.
Yeah. Okay, good. Well, again, let's switch sectors. Let's go to the consumer. We've got a question actually coming in from Phil Curtis. He's asking about Diageo, which is a premium sort of drinks and spirits company. But just more broadly, let's start with the sort of the health of the consumer, because we've got sort of like top level consumption, sort of like on the luxury goods. LVMH has struggled a bit with China, with that consumer. The American consumer is going gangbuster still, and there's people enjoying experiences. But at the low end, spend has obviously shrunk off for people who have got low disposable incomes because of inflation. So two-part question. What's your sort of overall health of the consumer with their decent balance sheets, and likewise, if you've got any views on Diageo at all?
Well, not really on Diageo specifics. I mean, I think that I was very critical of these stocks back in 2021. Wrote an article in the Ruffer Review saying that these and the high-profile fund managers who were of course loaded with these stocks at the time were all superstars. But I thought that they had reached a point of valuation where they looked a bit like the Nifty 50s. And of course, they've all derated. The Unilevers, the Diageos, Nestle have all come back, and we now own a few of these stocks. We've got Reckitt, we have Unilever, we have Heineken, Ambev. We have looked at Diageo, sort of thinking about it. The truth is, the consumer is okay. The lockdown savings have now been spent, but there's wage growth, isn't there? And real wage growth, at least temporarily, whilst inflation has receded. So never bet against the American consumer. The marginal propensity to spend of the average person is very, very high in the UK and the US. We will see if there is a bit of a transition going on here, where people are moving away from luxury goods and moving away from the premiumization trend that's dominated drinks for the last decade, and whether they're going to experiential stuff rather than drinking Johnny Walker Black or Blue, whatever the expensive one is. We'll see. And I do think there's an interesting story or lesson within the luxury goods space. You've seen high profile problems at Burberry, at Kering, at LVMH to a slightly lesser degree. But Hermes is flying. And I think there's maybe a lesson there that at the very, very top end, there is no slowdown. The buyer of a Birkin handbag is not price sensitive. The buyer of a handbag at $2,000 or $3,000 is sensitive to a 10-20% price increase. But that's absolutely reflected in the valuations. Just one quick anecdote on that, and this is why I worry about the crowding and narrowness of markets. I was at a conference the other day. 3 equity managers were on a panel, and they were asked what their favorite stock is, and their top pick. Now, there's 50,000 listed equities in the world, and 2 of the 3 managers chose Hermes.
Wow.
2 of them chose Hermes, and one of them said Hermes is the sort of stock that you buy and never sell. No, I just thought this is, that's, you're late in the game when you get to that sort of levels of confidence. So, is Hermes a great company? Of course. Is Diageo a great company? Of course. But there are prices at which these become attractive investments, and I think Diageo, Reckitt, Unilever, they're much closer to the price where it can be a good investment than something like Hermes, which is very vulnerable to a shock because it's priced for perfection.
Yeah. Okay, good. Let's just talk about then Reckitt, because they came out with sort of their quarterly results, I think. Was it this week? And I think they've decided now to reduce their price increases, getting a bit of extra volume coming through. And they were reasonably well received. I think the shares sort of picked up. They've got this real problem, I think, or they've had this litigation problem with their infant milk formula out in the States and stuff. But what's sort of like the investment thesis on Reckitt at the moment? Because it was a sort of like a darling of all things, FMCG, sort of personal hygiene and health, and obviously, cleaning.
Yeah, I mean, these stocks were market darlings from 2012 through to 2018, and now all of a sudden they're viewed as a bit stodgy and a bit out of favor, and there's a few activists involved, and there's management changes and so on. But if we go back a bit and think about how do Ruffer think about equities, because you usually have equity specialists on who are very much in the weeds, and I think we do things slightly differently. We are a macro and asset allocation house predominantly. That's certainly, I view myself as a generalist. We've always done stocks directly, but we think about them differently from a pure stock picker, although we do have a whole selection of equity focused analysts. Historically, we've probably had a bit of a value bias as a firm, but I do remember I chaperoned Jonathan Ruffer to the London Value Investors Conference in 2018, where he was making the keynote speech. And he opened with, "I don't know what value investing is." And he never got invited back. But we try to be quite open-minded about how we do our equities by region, by factor, by style. And there's lots of examples of that in the past. We've owned FANG at points. We had invested in Ocado very early, and thankfully sold it relatively well. So how do we look at equities? We probably start with a macro or asset allocation insight that might make something interesting. We run lots of screens for valuations to narrow down the ponds in which we're fishing, and we consider on a more tactical macro basis what factors we might want, and that's really what led us to what I would crudely describe as the cash flow blob equities in our portfolio. So that's Unilever, Reckitt, Heineken, Bats, Pfizer, Roche. And I don't want to oversell these because they're all quite small positions in isolation, but cumulatively they add up to a decent amount. And we wanted high levels of recurring free cash flow, strong brands, which clearly Reckitt has with Dettol and Nurofen and so on, low valuations, attractive dividends, but they each have their own problems. And that's why they've gone from darling to unloved. Reckitt, like you say, has a litigation problem. It's got a bit of a growth problem. It's got a pricing problem, but it now has activist investors, and we think that they are righting the ship. I mean, I think it's as simple as that. That the gap between the valuation of Unilever and the valuation of Reckitt is about as wide as I think it's as wide as it's been in my career. Probably 30% in there. We do own both, but that's why we own more of Reckitt's.
Yeah, I think Reckitt's is about 15.5 times PE, where Unilever's probably 20, is it, or something?
Yeah, and so Reckitt's has gone from, I mean, these were bond proxies when a bond proxy was a wonderful thing to be. Now a bond proxy is not a wonderful thing to be, and so people have shied away from these stocks.
Yeah. Okay, good. Well, again, let's move to another area. This is a big non-consensus view that you have here, just on China. What your thoughts on China? And obviously, you own some sort of beneficiaries of sort of Chinese growth, economic growth outside, but also you own Alibaba as well, which is the equivalent of Amazon in territory.
Yeah, the equivalent of Amazon and PayPal.
And PayPal, that's it.
Yeah, I have Alipay. So our China exposure, we have 5% in direct Chinese equities. So that is 1 and a bit percent in Alibaba and 3% in the Chinese ETF. And then I would say we have some proxy Chinese exposure via Prudential, which of course London listed, and also some of the commodity exposure is clearly related to China. So that would be ArcelorMittal, Glencore, Rio Tinto. Now, the way I've been thinking about the Ruffer portfolio this year is that we have a collection of ugly ducklings. We have a collection of themes and assets that nobody wants to touch, that are deeply unloved, that we think will have this redemptive moment like the ugly duckling in Hans Christian Andersen's story that realizes that it's a beautiful swan. Now, China is without question the ugliest duckling. Whenever I speak to anyone about it, one of the first words is uninvestable. Yes. And I think that actually should be music to people's ears if they own the stock, because it's a closed-minded approach. It says, I'm not really interested in hearing your bull case. And if I said to you, you could buy all of Alibaba for a tenner, that's something you might be interested in. Like, clearly there is a price at which you would be interested in buying an asset, even if that asset comes with significant risks, as Chinese equities evidently do. So yes, we totally acknowledge the China bear case. If Xi invades Taiwan tomorrow, the risk that these stocks are zero, just like Russia, is non-zero. You know, that is a proper risk, and we're not hiding from that. What we're saying is that probability adjusted, it's probably in the price, or at least to a large degree is in the price, and on the day that something awful like that happens, because that really is the kickoff of World War III, the rest of our portfolio, to the extent that that matters on the day that World War III begins, probably does very well. I think gold is roofing it that day. Oil is doing very well. Our unconventional protections, S&P puts, volatility call options, credit protections, these are all doing very well. The S&P is not going to like China invading Taiwan. And it's slightly facetious, but I think it's totally underappreciated. Global investors need to appreciate that they are long China anyway, even if they zero weight China in their portfolio. But the Starbucks, LVMH, Tesla, Nvidia, these are all China proxies, but they are on much higher, 3 times the valuation in some instances of Alibaba. And Alibaba, you're buying it at half the price Charlie Munger bought it at. That's a good start. And since IPO, the revenue has 12x'd. I think the profits have 10x'd. Of course, enormous capex and R&D, and the share price is slightly down. That's a pretty good start, I think. So,
how do you actually buy the shares? What sort of like, because overseas investors can't own Chinese stocks.
We buy the ADR.
Okay, and the ADR is basically based off a Cayman Island sort of derivative that actually doesn't. It's just all it is basically I don't know. It's a sort of like it runs off the Hong Kong share price, but it isn't actually any call on the equity, is it, legally? I don't think.
Are those not the VIEs that you're talking about?
Yes, that's it. The VIEs. Yeah, I was just trying.
No, I believe that is different.
Okay.
You are right at the edge of my competence there.
Yeah, no, that was what I mean. I would agree with you. Chinese equities. What's always been a head scratcher for me is that the economy is grown incredibly, but the equity market has been trash because there's excess capacity. They've basically built, and they tried to dominate export markets. You've had obviously the overhang of the tech crackdown. You've got trade wars potentially with Trump. Admittedly, that's all baked into the price, and then it decides on what, is the story going to get better? Is the share price going to recover if the story gets less worse? And that's really what you're betting on.
A really good way of putting it. I am a strong believer. We are strong believers in the idea that you make the most money when things go from terrible to okay,
yes.
and rather than okay to great. And I think you're seeing a little bit of that. So China has now, to a large degree, backstopped the market with their interventions in the last couple of months. We saw Alibaba bottomed at $72, I think, in June. It rallied to $115 in early October or late September. We sold some, thankfully. Of course, wish we'd sold more. And I think it's now trading at 92. So you had a huge rally, you had a 50-odd% rally, and then you've given half of that rally back in the last few weeks. But I think what has happened is that the Chinese stimulus efforts, and it hasn't just been one bit of stimulus, which is what we've seen historically. This has been a sustained drip of positive news across every conceivable bit of the market. They're giving companies interest-free loans to do buybacks. They are increasing stimulus in the property market. They're cutting interest rates. They're providing liquidity. This is a very comprehensive package of measures from the Chinese state. The truth is, we don't know if it will work. It's definitely enough to improve animal spirits a little bit, to improve liquidity. Is it enough to turn around the Chinese economy and address their ongoing balance sheet recession? We will see. But I think it does put a floor under the equity market to a large degree. I'd recommend that any of you go and find the CNBC interview with David Tepper, which was his China bull case. Slightly worrying. Like he said, he'd bend his own risk limits in his fund to go extra long China. But I think he was very persuasive. So we will see if there's legs to this. But nobody has any exposure here in the West. We've all spent the last 5 years getting our China exposure down to zero and shunning those stocks. And you saw that in the August sell-off, where global markets took a really nasty hit in a few days and Chinese equities were flat. They were flat because no one owned them to sell them. It's almost become a completely isolated and annexed capital market.
Yeah, no, it is. There's no doubt about it. There's a lot of bad news in there. And I guess let's assume Trump, for this instance, does become the US president, and it tends to be his sort of like modus operandi that his bark is worse than his bite, and therefore the 80% tariffs he's put in on sort of Chinese goods isn't quite as bad as they say, but it's but 80% is already baked into the market. So you're right, you'll probably get a positive bump on that, I guess. But
he has this incredibly simplistic but effective bargaining technique of asking for something truly ridiculous and settling for something a bit more moderate. People don't like it, but it does seem to work sometimes.
I know. I've got to hand it to him. His bargaining strategy does seem to be effective. Did with North Korea and did with China previously. Okay, let's move to a less volatile sector. We've got healthcare. Let's start off with a company that reported this week, Roche, that has got two divisions. It's got 75% of its revenues in pharma, largely in things like oncology, eye disease, and I think it's in multiple sclerosis as well. And it's got a big diagnostics business as well. It's recovered. It was a COVID darling, but it's now recovered quite a lot actually. What's your sort of trajectory for Roche Therapeutics?
So this is a pretty small position. It is part of that cash flow blob basket that I mentioned. You've covered. It's a Swiss healthcare company, diversified, highly diversified across pharmaceuticals and diagnostics. It has been an underperformer over a number of years because management have been pretty weak and uninspiring. R&D hasn't quite worked out. There's been a lot of spend there with very little return. But there is a new management, and that's a recurring theme in a lot of these. That whole basket, that previous management underwhelmed and underdelivered. and there now needs to be significant change at the top, and that makes it a little bit like Pfizer in that regard, that you had. Pfizer is another one in the basket where you had a huge boom during COVID, of course, because of the vaccines. But then it became up. What next?
Oh, hang on. Sorry about that, of everybody. I think we just had a broadband problem.
Oh, you missed all my pearls of wisdom.
Yeah, sorry about that, Duncan. If you could repeat what you were talking about.
So the other pharmaceutical company in the basket is Pfizer, which has a similar shape, very cheap stock, 6% dividend yield. It's having had a hugely successful COVID because of the vaccine. It's had a bit of a disaster since. It's approaching a patent wall. They've had to do a big acquisition in terms of CGen, and there we are backing the CEO, who's a very intense character, to inspire what has been historically a pretty sleepy business, because it had this windfall in COVID, and now it's well, what next?
Yeah, I mean, it had the well known obviously for its COVID, wasn't it? Basically, the COVID vaccine did really, really well. But now it's got Starboard on board, an activist investor who just got. I think they tried to get the previous CEO to actually kick out the existing CEO to change it. But you're suggesting that they're on the right track, are they?
Yeah, well, like I said, activists are a strong theme here. You have activists in Unilever, you have activists in Reckitt, you have activists in Pfizer, and I think that shows that the underlying cash flows of these companies, which is why we own them, are very, very strong. But there's an argument that they are being misallocated or could be used better for shareholders. Yeah, and another example actually in the basket, although to go from healthcare to tobacco perhaps might offend some people, but I think BATS is a great example of a stock in the basket. It's about 0.7% of the portfolio. So British American Tobacco, it's of course a leader in tobacco, but it's also a leader in vaping. Yeah, and we think vaping might even be a better business than tobacco, but it sits under this huge regulatory uncertainty cloud where you can make a reasonable case that it will be either positive or negative when the regulation gets resolved. But in the meantime, you've got a very cheap stock that sits on 7 times earnings, pays a 10% dividend yield, and I think the shape of it, for an inflationary world, if you believe our view that the world is structurally going to be more inflationary, what could be better than an entrenched oligopoly with a pretty leveraged balance sheet? In that respect, actually, if the world is inflationary, leverage is actually a good thing, and a huge amount of pricing power, and a very stable product, of course. So you don't need to worry about economic uncertainty jeopardizing the leverage. And you look at the stock valuation at 7 times earnings and a 10% dividend yield, it's almost saying this business won't exist in a decade. Yeah. And I went and checked this morning. They have a perpetual bond that yields 3.8.
Wow.
So the bond market tells you this stock is going to be around forever. Yeah. And it's not a very liquid bond, but I think the point holds that the bond market's telling you tobacco is a great place to lend money for a very long time, because we're not all addicted to it, but a lot of the world is addicted to tobacco and increasingly to vapes. And the stock market is telling you there's so much uncertainty here that the business won't exist. And I think I'm betting that the bond market will be right, so you want to own the stock.
Yeah. So how, just on big picture wise, how do you actually do an either or in terms of choosing dividend paying sort of like bond proxies like BATS or Pfizer, which pays 5.5% dividend yield, compared to sort of like, short-term gilts or short-term treasuries, which haven't got the credit risk, but frankly, or equally haven't, maybe not as, the dividends aren't as high, and also, basically they haven't got any potential capital appreciation.
Yeah. So the way I would, and it's a bit of a shorthand, but it's a nice way of thinking about it. You could compare a Unilever and a BATS and a Nestle. I would say you compare it to an index-linked bond rather than a nominal bond. So you look at the the yield on an inflation-linked bond today, you can lend to the US government. The 10-year real yield, I think, is 1.9. I guess the 30 years probably 2. So you can lend to the US government for 2% plus inflation for however many years. That's a decent return. And that's why we've held those assets a couple of times in the last few years. We don't have them right now, but I think they're getting back to a level that could be quite attractive. That is a nice hurdle rate to compare all your other investments to. But then, like I'm saying, if you look at BATS, you could, I think, make a reasonable case that BATS is an inflation-linked, BATS equity is an inflation-linked bond to a large degree. But of course, you're taking idiosyncratic risk of accountancy and management competence, and of course there's a little bit of cyclicality, and there's things could happen in the different regions that they operate in. But I that's why we've gone from a zero weighting in these formerly bond proxy darling stocks to now having a reasonable amount in them, because especially if you own a few of them in a basket, you're quite diversified against those idiosyncratic risks, and you own something a little bit like an index-linked bond with a bit more cyclical risk, which you have to be aware of, but it yields more than 2.
Yeah. In terms of your fixed income, your bond holdings, which currency do you put them in? If you're trying to double, or make sure you have a hurdle of twice the cash return, etc., which currency do you put your bonds in? Presumably in gilts, I guess. But
so we have most of our short dated exposure in FRN, so US FRNs, so that they earn the 5% Fed funds rate.
What's an FRN?
Sorry, a floating rate note. Very short dated T-bills, effectively. Yes. So US government liabilities, as safe as it gets. No interest rate risk, because the FRN, the rate is floating. So that's where most of our money sits. We've owned short-dated UK gilts. As I'm sure everyone on the call knows, short-dated UK gilts, the low coupon ones, extremely tax efficient. But that means they actually trade very expensively. So for us within the funds, they're not a particularly good investment, because they trade well below the swap rate because of that tax efficiency. And we own quite a big chunk of Japanese government bonds, because we want the yen exposure. So they have much lower interest rates, which is unfortunate, but they are denominated in yen. So when we want to express a bullish view on the yen, that's one of the ways that we do that.
Right. And do you so essentially, if you're trying to beat sort of like, I don't know, is it cash return? You're trying to beat the gilt return by 2%. You do run a sort of forex strategy, essentially.
So Ruffer's objectives are to not lose money, and then to do significantly better than cash over a full market cycle. That's really why people invest with us. So that there is a rolling 12-month element of the benchmark, but we try not to manage to that.
Yeah, okay. And the cash element to beat is basically sterling, is it? That's it. You're doing sterling cash. So you use Forex to essentially put your view about which currency will do better to generate that better than sterling return.
So in the history of the firm, we've done a reasonable job in the past of using currencies as an extra protective asset. So most people will be familiar with the role of the dollar in this. Yeah. If you think about the financial crisis, the dollar rose dramatically against sterling. So people's dollar assets were actually very helpful to their portfolio. We went into the financial crisis with yen and Swiss franc exposure, which operated like even more of a safe haven currency, particularly because they were both used as funding trades or funding currencies in the carry trade. So we think that is an underappreciated tool in a multi-asset portfolio, to use currencies to add a hedging capability. And today we think the yen is extremely attractive on that basis. It's very cheap. You can demonstrate that. The tourism numbers are through the roof, because for the first time in my lifetime, Japan is a cheap place to go on holiday. But also because Japan has had zero rates for the last few years, whilst the rest of the world has been hiking, you've had yen weakness, but everyone has been massively incentivized to borrow in yen to fund their investment activities or speculation. And even Warren Buffett's doing it. Warren Buffett's borrowing in yen. So now Warren Buffett's doing it very sensibly, of course, but shorter term speculators at the pod shops or at Cargill or Glencore and so on borrow in yen and go and fund the commodity or whatever that they're buying and they're buying. But when the market turns or you get a vol episode, they have to they get the tap from the risk manager and they have to sell that asset, turn around and buy back yen to close out their loan. So you get this dynamic where people panic into the yen and the yen squeezes up. So that's what happened in 2008. The yen doubled versus sterling in 2008. And we expect when the market turns, when risk sentiment turns for more than a couple of days, like it did in August, that you will get that dynamic and the yen will appreciate dramatically, we think.
Yeah, that yen carry trade, it's sort of like a spiked on the Monday and then went sort of decimated, went back the other way by the end of the week. But I'm actually with you. I think given that overhang of the budget and Rachel Reeves's decision seems to be to relax debt measurements in the UK, which means that she's going to spend. Actually, I'm quite bearish on sterling actually going forward. I suspect that's going south.
So I saw that headline yesterday that we will, what was it? We will measure debt differently.
Yes, I know.
I thought, that it just shows how markets are so context dependent. Because is that really any different to what Liz trusted? Like
no, I agree.
And yet the context is different. Markets are a little bit less febrile because, of course, rates were going up globally at the point when Liz Truss did that. So people were minded to panic. Yes, so I think when you hear the Chancellor of the Exchequer saying things like that, I think you add that to the pile for the bull case for gold, that we will measure debt differently going forward. However, and we've talked about this a little bit internally, we'll find out in a week, but there's the possibility that they have sandbagged expectations and will surprise positively. They really have done. They have massively talked down economic prospects and talked about how awful this budget is going to be. But then the political calculus is surely that you front load all the pain into this budget and maybe next year's. And then that hopefully means that in the back years of the administration, as you get closer to the next election, you can start handing out some sweeties. Maybe.
Yeah.
So I think sterling's quite hard from here.
So do I. I think one of the reasons why they're looking to, sort of like balance the book, so to speak, or try to, is that send sterling down, boost exports, and then yes, in dollar terms, the economy is going down, but in UK sterling terms, it's growing in nominal terms, and therefore your debt pile to GDP actually is boosted by the exports. I think it's one of those de-sterlerization sort of like jobs, but that means overall, I'm probably sterling bearish going forward, but hey, we'll wait and see.
Yeah,
I would love to think it's going to work, but it might take a long time to do so. Okay, let's move to another quite controversial share, but seems to be coming back. Is in healthcare and agri-tech. Is Bayer, which I did see on your last monthly report you just bought.
You're picking all the rotters here, aren't you?
Well, it's a good thing. It's a good theme because they're fallen angels. You seem to be able to select things. You're monitoring a shed load of stocks, really good quality businesses, to get to a point of maximum pain, and then you sort of like push that value button, buy in, because there's so much bad news in. You only need a little incremental sentiment.
So on the face of it, Bayer, when I talked about we look at things through factors to begin with. European equities are unloved. Pharma is unloved. Agriculture is unloved. And we like commodities. So Bayer, from the highest level, couldn't look better. But of course, the truth is that Bayer is a bit of a disaster. This is deep value.
Yes.
They need to improve their execution. They need to deleverage. They bought Monsanto, which was a fantastic business, but they paid a huge price for it, and they inherited all of Monsanto's legal liabilities, which are potentially very large and an unknown. But this is a stock that is absolutely hated.
That's the one you're talking about is Roundup, where they bought the weed killer, wasn't it? And they've got about an estimated £18 billion bill, which I think they've paid most of it for.
Yeah, and that's one of the reasons why they still have lots of leverage. But you've got new management. The litigation and ESG angles are slowly being cleared up. But it's that if they can do that in the background, whilst the markets start to reappraise the value of commodity exposure, the value of the stable free cash flows from the pharma business, and maybe you get the long-awaited but rarely seen rest of the world start to outperform the US. I mean, Bayer is one of the few stocks that's big enough and liquid enough for US investors to buy. Yeah. And I would genuinely, when you look at the European index, there's Nestle, LVMH, Volkswagen, and Bayer. That's about it in terms of what can these massive US fund managers get exposure to. So but Bayer is. I said China was the ugliest duckling, but Bayer's not more behind it. Again, it's also not a particularly big position for that reason.
Yeah. Okay. I'll be a bit remiss of me not to talk about defence, actually, given it's done so well. And I know you're only a small position in it, but just talk about sort of like how you see the wars in Ukraine and Middle East. Have you got any thoughts on longevity? And also, because I know you own a very small position in Rolls Royce, which has been a bit of a rocket ship on the back of that, and its turnaround under its CEO from about 2 years ago.
Yeah. So, well, the defence as a theme, we don't really have much here. We have We've taken profits in Rolls Royce and a little bit of BAE Systems, so they're very small positions.
Yeah,
it has similar shape to what I said about oil, in that you have a valuation case. These stocks. Well, they were much more unloved pre-Ukraine, of course. They were terribly unloved and bad ESG stocks going into 2022, and then people realized that actually these companies provide some of the tools that allow people to fight the bad guys. So maybe they're not bad ESG stocks. So there has been a bit of a reappraisal there, which is why we have less in them. But also you can see how these are stocks that might do well in bad market scenarios. But Rolls Royce is the never ending. So Rolls Royce position is about 12 basis points.
Yeah, of course. Small.
So it's the never-ending turnaround, isn't it? It's a very, very messy conglomerate. It had a nasty COVID. It's pretty much had a nasty decade. But there is a new management team. Again, that recurring theme, trying to turn things around, trying to turn around the cash flow and to sort out some of the messy accounting with the engines business and so on. These can be huge upfront investments that then become cash flow generative in the back end. And what we've seen with the share price recovery is that the market's starting to believe that this might happen, because if they get it right, if they get that engines business right, you've then got a phenomenal business for the next 20 years. Yeah. As those engines get serviced and through their useful life. But you just have to spend a huge amount of money, and you have to get it right to get to that point. So there's still upside as that transition becomes appreciated, and the business clearly now has momentum. But to come back to what you said earlier, you make the most money when things go from awful to this might work, rather than this might work to it's a great business.
It's also another very good illustration of how turnarounds can work. The higher risk, no doubt about it. But if you back a team that has actually, and I remember the CEO saying, so this something like this platform's on fire or it's burning or something like that. And I thought, and I remember that was when the shares were below £1, and I thought, right, he's kitchen sinking all the results. But actually, from that moment onwards, the shares have just taken off. So. It just shows you that if you've got the right management team, you can kick sleepy companies, which have got a lot of potential, back into good shape. We've got a quick follow up from John Shinner. He's asking about with your Japanese exposure there, Duncan, with your bullish call on yen. Do you buy just the bonds, or do you look at equities as well?
Yes, thank you for that question. So when I joined Ruffer, 2012. We had 24% in the yen sorry, in Japanese equities, and we had
Yep.
0 in the yen.
Yeah.
And back then, the Nikkei was about 9,000, 10,000, and the dollar yen was 90, I think.
Yeah.
Fast forward 12 years, the Nikkei is now 40,000, so it's gone up 400%, and dollar yen has gone from 90 to 150 odd. So the yen has dramatically weakened, and we have 0 in Japanese equities and 15 in the yen. So I think if you look at the two snapshots at 12 years apart, we owned the cheap thing and avoided the expensive thing back in 2012, and now they have reversed roles, and we now again own the cheap thing and have gotten rid of the more expensive thing. I am more bullish than most of my colleagues on Japanese equities. I see the case. I still think the restructuring case, the corporate governance case, is very strong and has tailwinds. You're seeing Western private equity get involved. I don't really know how to pronounce it, but Couche-Tard, the Canadian grocers, is trying to buy Seven & I. That will be the first hostile takeover in Japanese history. So there's a real story there being implemented by AVI Japan and Nippon Active Value, which are both London-listed investment trusts. However, the truth is that Japanese earnings are highly sensitive to changes in the yen. So if we are right about the yen, i.e. the yen is going to go up, and we own that.
Yeah, okay.
That provides quite a big headwind.
Yes,
to Japanese equity earnings. However, there is no doubt that our performance would have been a lot better in the last 18 months had we held our Japanese yen exposure via the equities.
Yeah, okay.
The problem with that is that becomes a bit of a hedged position. When one goes up, the other one goes down, and so you end up with a bit of a muddle. But that would have been definitely better for us. As at the moment, the way we currently held it, we felt the weakness of the yen weakening, but we haven't had the offsetting return of the Japanese equity market going up.
Yeah. Okay.
Also, I would make a big distinction between the large caps and the small caps in Japan. The large caps are no longer, and the large caps are the ones that are more yen sensitive. They're no longer really that cheap.
Yeah.
Whereas the small caps remain very attractive.
Yeah, small caps seem to be cheap everywhere in the world, actually, the US, UK, and
as you know.
Well, I think what's quite interesting there is that passives, unfortunately, and ETFs and trackers, where people have moved into it, they've obviously, chucked into cheap, low cost ETFs, which has just sucked money out of all the small caps. And you can't buy trackers in small caps, generally speaking, and therefore it's just taken money out. But hopefully at some point, if the earnings cycle does happen in small caps everywhere, then that will drive money back in. But it's been a technical thing.
And look, there's that stat. There's that stat kicking about that. What is it? There's more ETFs than indexes, and there's more indexes than stocks.
Yes.
So the other day, I was intrigued and thought, I wonder if there's an AIM ETF, because they're thinking about what Rachel Reeves is going to do with the budget. If she, AIM, like you said, it's down year to date. I would think there might be a huge sigh of relief in AIM, a relief rally, if she leaves that untouched. But I couldn't find one.
There isn't.
There's a my favorite one that I used to slag off was the vegan ETF. Yeah. There was a vegan ETF which owned things like Microsoft and Apple. Because of course they always want stocks that have gone up and the biggest and most liquid stocks to populate their ETFs, because that makes life easy. But there's a vegan ETF, but not an AIM ETF. That tells you how unloved UK small caps are.
Yeah, well, you can't create one, unfortunately, because the liquidity is so poor. So
true.
It's a sort of chicken and an egg as much as anything. But it's one of the technical reasons why valuations at the moment are so low. Now let's We've got 4% of the portfolio in UK small caps. I think that's definitely worth highlighting. That I think there's pockets of extreme value there. Yeah, I wouldn't quite say pockets. I'd say absolute caverns. I'd say absolute masses of opportunity.
I will not disagree.
But there is high volatility. Okay, let's just quick finish on the Mag 7. What's your view of the Mag 7? It's done so well. You own one, I think, which is Amazon.
Yeah, we've owned all of them at some point. Of course, I wish we'd owned all of them all the time in bigger size. But we have at various points owned all of them. I think it's not difficult to double your money in the Mag 7. They seem to go up every 18 months or double every 18 months. But Yes, I mean we've been way too critical of them, and they've been very good at reinventing themselves and creating new business lines and so on. Like that's one of the reasons why we like Amazon, is that of course it's not just an e-commerce stock. E-commerce is still increasing in penetration. I can't believe that e-commerce is only, what is it? Is it 30% of sales in the UK and 15 in the US? I mean, in the MacInnes household, I think it's like 80 or 90. Just I don't do any shopping in shops. So they're Amazon gets no credit for its vast R&D and capex budget. So I haven't fact checked this, but I heard it the other day that Amazon's R&D spend is greater than the entire FTSE 100s.
That doesn't surprise me one bit.
Sounds ludicrous, but when you think about how big Amazon is, actually, it's about the same market cap as the FTSE 100. So, and probably much more efficiently spent, actually. So they're creating an AI chips business that might one day compete with NVIDIA, yada yada. So you're paying an expensive valuation for the core Amazon business, but you're getting a lot of optionality for free or for a low price. In general, I think you have to be very worried about the level of concentration in markets. So there's so many different levels to it. You've got 70% of MSCI World is the US, and then within the US, within the S&P, I think if you properly account for it, technology is something like 40%, which is very, very high. And then, of course, within that, you've got the Mag 7, which is, I don't know, where is it, 30% today, 25%, very high. And then within that, you've got two stocks that are 6%. So you've got Apple and NVIDIA both sitting at 6%. We've never seen, or you have to go back a very, very long way to find this level of concentration. You have to go, well, you've never seen a situation where NVIDIA has gone from effectively nothing to the biggest company in the world in the course of 2 years. My criticism would be, these are amazing businesses, and I'm just being a hater because we haven't owned enough of them. But the
FOMO.
Yeah, exactly. They are becoming much more capital intensive.
Yes.
And so the R&D budgets are well known. Microsoft spending $60 billion a year. I think Google $50 billion a year. These are crazy numbers. Their CEOs admit that they don't, especially the AI related spend. They honestly can't tell you what the return on investment is. But Larry Page said he would rather go bust than lose the AI race. Mark Zuckerberg has effectively said it's a bottomless pit, but it's a race to the bottom. And you can see it with the deals that they're doing. Microsoft buying a nuclear reactor. I think Amazon did something similar. They're all moving further up the further down the value chain, up the value chain, whatever. They're securing their own power supply because AI is so power intensive. But that means that they're slowly but surely turning themselves into utility companies. But Microsoft's ROE on Microsoft Office is infinite because it's cost them nothing to sell a marginal copy. When Amazon has to own a power plant, well, you know what the returns are on that, and they're not very good. That's why nobody wants to own National Grid and United Utilities. And so on.
Yeah, sorry, I lost you there, but anyway, we'll wait.
Clearly, the Mag 7 need to do more investment on internet technology.
No, sorry about that.
The point was they're spending a huge amount of money. The marginal returns on that investment is not potentially lower; it's demonstrably lower. We know that they are investing in low returning data centers, in lower returning utility and energy provision, and therefore, in the future, they should theoretically trade at a lower multiple. So I do worry about that, but who am I to listen to on the Mag 7 when I've not owned them all the way up like some really clever people?
I did hear actually quite a bullish point for Amazon on its e-commerce platform because it's moving from 2-day to same-day delivery. One of the big bugbears of e-commerce is the failure when somebody puts a product into their basket to complete the purchase. And apparently, if you move from 2 days to 1-day delivery, Amazon are seeing already when they're doing that they get a 20% uplift in that conversion rate, which is massive. So not just for them, but for their partners. Okay, good. Well, let's just close it. We've got last final question, which might be the hardest here, Duncan. Looking forward in your crystal ball for 2025, what's the best asset class or the best stock idea for the next 12 months? And don't say gold because you've done so well out of it.
Yeah. Can I do two?
Yeah, please.
So I think on the long side, you would want. I think we haven't really talked about it, but the investment trust opportunity set is very, very interesting. So you can buy UK small caps on a 10-20% discount to NAV. There's lots of alternative assets like PRS REIT, which we own in the portfolio, which I think is as announced, the strategic review is up for sale. So I think there's some very attractive risks. Taylor Maritime announced its results this morning. So a basket of well-chosen investment trusts, and we own 6 investment trusts in Ruffer Investment Company. And then on the other side, because Ruffer like to have a balance of protecting growth assets, we think that the most asymmetric hedge available in markets at the moment is being effectively short investment grade credit. Not because we think those bonds are going to go bust, but because we think that the risk is totally mispriced. They're basically at post financial crisis tights. So these companies are paying almost nothing to borrow money, and that is a pure risk premium or sentiment indicator. So when markets sell off, that spread widens, and we'll make money from that.
Yeah, so you're basically talking about the tightness of the spread and the corporate credit.
So actually, I'm saying you want to be long, very dislocated spreads in investment trusts, the spread between the price and the NAV, and you want to be short one of the tightest spreads in the world, which is investment grade credit. Yeah.
One of the things on that one, though, which I've sort of like thought about, is that given that the leverage of the major sovereign issuers, the US, the UK, their percentage of debt to GDP is rising so much. Actually, the credit quality of a corporate is getting better than actually the countries.
So I would say, look, that's totally rational. However, and it had to be rational, because did Nestle not issue a bond on a negative yield at some point in 2015 or 2016? Remember, there was $1 trillion of negative yielding debt.
Yes.
I'm pretty sure Nestle issued a bond at a negative yield.
Yeah.
So people were paying Nestle for the privilege of lending Nestle money. If that wasn't a sign of insanity, I don't know what was. So clearly that type of thinking has happened in the market.
It happened at the European debt crisis, when a lot of corporates in Europe could issue shares much cheaper than the sovereigns.
So I think Europe is unique, though, because in Europe they can't print their own currency. Whereas I would say in the US and the UK, it doesn't matter how good a corporate it is, the US Treasury can print dollars, so they're not going to default. They might default in soft terms, i.e., the real value of what you get back might be reduced. Absolutely can get on board with that. But I think the idea that corporates trade inside treasuries for any sustainable period is pretty nuts. In my opinion.
We've had that a few times.
Well, yeah, it's happened a few times. Yeah, crazy things happen every day. Yeah, never say never.
Yeah, okay. All right, well, brilliant. Well, thanks very much, Duncan, for an unbelievably insightful view of the sort of the macro and asset allocation.
That's very nice of you.
And a deep dive into a number of different sort of like good sort of asset ideas and stocks. And apologies for the audience for the sort of dodgy broadband. I don't know what happened today, but anyway, thanks a lot, and look forward in chatting in probably about 6 or 9 months' time.
Cheers. Thank you. Thanks all.